picture this. You open your investment app on a quiet Sunday morning, coffee still hot in your hand, and you watch your portfolio cross $240,000 for the very first time. You stare at the number. You set the phone down. You pick it up again. That number represents 7 years of packed lunches, declined vacations, and the discipline to automate a transfer on the first of every single month without ever touching it. $240,000. And yet something feels off. Not wrong, exactly, but incomplete. Like you've been running hard and are starting to wonder whether the track you're on actually leads where you think it does. By the time you finish this, the way you see your investing strategy will have shifted permanently. Not because you'll learn a new app or a better stock pick, but because you'll finally understand that there is a specific number, a mathematical bending point, where the rules of building wealth completely flip. And if nobody has told you what changes at that threshold, and more importantly, what you are supposed to do differently when you cross it, then everything you've been doing right could quietly start working against you. Most people think building wealth is a slow, steady, linear process. You save a little each month. The market goes up over time. You stay patient, and eventually you get there. That is the version of the story that gets told at dinner tables and in personal finance books aimed at beginners. And for the first $100,000, that story is mostly true. Your savings rate is king. Your discipline is everything. The size of your monthly deposit is the single most powerful lever you have. But that story has a hidden chapter that almost nobody talks about. And the chapter begins at $250,000. Meet Marcus. He is 34 years old, earns $68,000 a year working as a project manager at a mid-sized logistics company. And he has been investing with almost religious consistency since he was 26. He maxes out his retirement account every year. He has a separate brokerage account that he adds $200 to every 2 weeks without fail. He does not buy things he cannot afford. He does not panic when the market drops. By any reasonable measure, Marcus is doing everything right. His portfolio just passed $240,000, and he is proud. He should be. Now meet Daniel, also 34. Earns $62,000 a year, actually $6,000 less than Marcus per year, working as a high school teacher in the same city. Daniel started investing 2 years before Marcus and had a few good years early on. His portfolio sits at $310,000. Daniel saves less aggressively than Marcus. He takes a real vacation once a year. He does not stress about money the way Marcus does. And yet, despite earning less, despite contributing less, Daniel's net worth is growing at almost twice the speed of Marcus. Same market, same index funds. Entirely different experiences. This is not luck. This is not a coincidence. This is a mathematical reality that Wall Street understands deeply, but almost never explains in plain language, because the moment you understand it, you stop needing the expensive products they want to sell you. Here is what is actually happening. And I need you to stay with me here because this is the core of everything. When your portfolio is small, say you have $50,000 invested, the market is almost a spectator in your wealth building story. Think about the numbers. If the market returns 8% in a year on your $50,000, that is $4,000 of growth. But if you are disciplined and you manage to save $10,000 that year from your salary, your contributions are generating more than 2 times what the market generates for you. You are the engine. Your paycheck is the fuel. Your savings rate is the most important number in your financial life. This is not a flaw. This is exactly how it is supposed to work at that stage. Your only real job when your portfolio is small is to feed the machine as fast as you can. Increase your income. Cut waste, deposit, repeat. The math is simple and brutal. At $50,000, the market is your assistant and you are the boss. But watch what happens when the portfolio grows. This is what I call the engine swap. The moment where the source of your wealth generation quietly changes without ever sending you a notification. At $250,000, an 8% market return generates $20,000 in a single year. $20,000. That is more than most people can physically save from their salary in 12 months. The market just contributed more to your net worth than a full year of disciplined labor. At $300,000, that same 8% return gives you $24,000. At $400,000, it is $32,000. The math keeps accelerating, and you did not lift a finger. This is the engine swap. Your portfolio has become the primary engine. You have become the supplement. And that flip, that quiet, invisible mathematical flip, changes literally everything about how you should be thinking, behaving, and positioning yourself financially. The first thing it changes is your relationship with your contributions. When Marcus adds $2,000 to his portfolio this month, that deposit is no longer the dominant force in his wealth equation. The market's daily movement on his $240,000 will dwarf that contribution. This does not mean Marcus should stop saving. It means the obsessive focus on savings rate, which was the right obsession at $20,000 and still useful at $100,000, is no longer the most important lever. The most important lever has shifted. The game has changed. And if Marcus does not realize the game has changed, he will keep optimizing for the wrong thing. The second thing the engine swap changes is the psychological experience of being in the market. And this is where it gets deeply human. When your portfolio is $40,000 and the market drops 10%, you lose $4,000. That stings. It is not great, but it is manageable. You can emotionally process $4,000. You can rationalize it, file it away, move on. When your portfolio is $250,000 and the market drops 10%, you do not lose a percentage point on a screen. You lose $25,000 in a single day, sometimes in a single morning. That is a new car. That is a down payment. That is more than some people make in a year. And your brain, your incredibly sophisticated, pattern-recognizing, threat-detecting brain, does not experience that as an abstract portfolio fluctuation. Your amygdala, the ancient part of your brain responsible for detecting danger, does not understand percentages. It only understands what that number means in real life. And $25,000 disappearing feels like danger. Here is what happens inside the skull of an investor who does not understand this mechanism. They open their app on a Tuesday morning. The market is down 8% because of some geopolitical headline. They see their balance has dropped $20,000. Their heart rate goes up. Their palms get slightly damp. Something that feels very much like panic starts forming in their chest. And their brain, specifically the emotional, reactive part of their brain, starts generating very compelling justifications for selling. This is different this time. Maybe I should just move to cash and wait for it to bottom out. I can always get back in later. This is not weakness. This is biology. And the people who lose the most money in market crashes are almost never the people who did not know to stay invested. They are the people who knew, but whose emotional brain overrode their rational brain when the numbers got large enough to feel real. The solution is something I call the emotional circuit breaker. And it is not a concept. It is a document. It is a literal piece of paper, or a note in your phone, or a private file on your laptop, where you write down your exact plan for a 20% market crash before that crash ever happens. You write it when you are calm. You write it when the market is green. You write it when your rational, clear-headed brain is fully in charge. And you write it specifically enough that when the crash comes and you are anything but calm, you have a set of instructions from your own rational self telling your panicked self exactly what to do. What does that document say? It says, if the market drops 20%, I will not sell. I will rebalance. I will buy more of what has gone down. I will do nothing that cannot be undone. The details are yours to fill in. The existence of the document is not optional, not when you are managing $250,000 or more, because here is the brutal truth about wealth destruction. Most people do not lose money in the market because they picked the wrong funds. They lose it because they panic sold at the bottom of a crash and re-entered near the top of the recovery. They bought high and sold low. Not because they were stupid, but because nobody told them that the psychological experience of a market crash scales with the dollar amount, not the percentage. And nobody told them they needed to write the rules of engagement before the battle, not during it. The emotional circuit breaker is your solution to that problem. Write it this weekend. Now, the engine swap also forces a fundamental rethinking of how your money is spread across different types of investments. And this shift matters more than most people realize. When you have $50,000 invested, a simple approach, putting almost everything into a low-cost fund that tracks the entire stock market, is not just fine, it is probably optimal. Complexity is not your friend at that stage. Your job is simple. Add money. Let it grow. Do not complicate things. A one-fund or two-fund approach is elegant precisely because it removes decisions, and fewer decisions means fewer mistakes. But at $250,000, the game changes again. Now the danger is what I call concentration risk. The specific and very real possibility that a large portion of your portfolio sits in a single sector or a single type of asset, and that sector gets cut in half. If you have $250,000 concentrated entirely in technology stocks, and technology as a sector drops 30%, which it has done more than once in the last 20 years, you have just lost $75,000. Not a portfolio percentage, $75,000. That is not a dip you ride out easily. That is a number that can make even the most disciplined investor consider catastrophic decisions. The solution is not to chase safety by moving everything to bonds or cash. The solution is structure. At the $250,000 threshold, the purpose of owning stable assets, like bonds or short-term government securities or money market funds, is not primarily about earning returns on those assets. It is about having what investors call dry powder. Stable assets that do not crash when equities crash are your ammunition. They are the financial reserve that lets you buy more of the stock market when it goes on sale during a crash, rather than sitting on the sidelines frozen, watching prices recover without you. This is how sophisticated investors actually think about diversification. It is not about hedging losses. It is about ensuring that when everyone else is panicking and selling, you are the one with the resources to buy. The crash is not the problem. Arriving at the crash without the ability to take advantage of it, that is the problem. There is a fourth shift that happens at the $250,000 mark, and it is one that almost nobody talks about because it sounds boring. But over a 20-year period, it will matter more to your final net worth than almost any investment decision you make. It is the tax question. Specifically, it is not just what you own. It is where you own it. On a $30,000 portfolio, optimizing your taxes on investment games might save you enough for a nice dinner out. It matters in principle, but the dollar impact is small enough to be secondary. On a $250,000 portfolio, the same optimization saves you thousands of dollars every single year. Compounded over 2 decades. The difference between someone who pays attention to where their assets are located and someone who does not can easily reach hundreds of thousands of dollars. Not because of any clever tricks, just because of structure. Here is the core idea, translated as plainly as I can manage it. Imagine your investment accounts as rooms in a house, and each room has a different tax treatment. One room is completely tax-free, what most people know as a Roth account. Every dollar that grows in that room, and every dollar you eventually withdraw, is yours. The government does not take a cut when you pull it out in retirement. Another room is tax-deferred, what most people know as a traditional retirement account. You do not pay taxes going in, but you pay them on the way out. And the third room is fully taxable, a regular brokerage account where your gains are taxed as they are realized every year. The mistake most investors make is that they fill all 3 rooms with whatever they happen to be invested in, without thinking about which investment type belongs in which room. The right approach is strategic placement. Your highest growth investments, the ones you expect to compound the most aggressively over decades, belong in the tax-free room, because when they grow by 300% over 20 years, none of that gain gets taxed. Your investments that generate regular income, like bond funds or dividend-paying stocks, belong in the tax-deferred room, because those regular payments would otherwise be taxed every single year if they sat in the taxable account. And your taxable account, the room where the government has the most access, should hold only the most tax-efficient investments, which typically means broad market funds that do not generate a lot of taxable events during the year. This is called asset location, not asset allocation. And it is one of the highest value, zero-cost improvements you can make to your portfolio once it crosses the $250,000 mark. All of these shifts point toward a deeper change, a change that is ultimately not mathematical, but philosophical, and it is the one that is hardest to make. When you are early in the investing game, with $20 or $30 or $50,000, your entire mental posture is oriented toward growth. You want the market to go up. You want your numbers to increase. You are, in a very real sense, playing offense. You should be. The goal at that stage is straightforward. Accumulate as fast as you can, grow the base, build momentum. But when you cross the $250,000 threshold, something has to change in how you think about the purpose of your portfolio. Because the portfolio is no longer just a number you are trying to make bigger. It is an asset that took, for many people, an entire decade of real discipline and real sacrifice to build. And protecting that asset, specifically ensuring you are never in a position where you are forced to sell at the worst possible time, becomes equally as important as growing it. The new question is no longer, how do I grow this as fast as possible? The new question is, how do I ensure I am never forced to sell at the bottom? Those 2 questions lead to very different portfolios. A portfolio built purely around the first question takes maximum risk, chases the highest possible return, and looks spectacular during bull markets and terrifying during crashes. A portfolio built around the second question is somewhat boring. It grows at 7 or 8% rather than 12 or 13. It does not give you spectacular months, but it also does not give you the kind of 20 or 30% crashes that trigger panic selling. And here is the counterintuitive reality. The boring portfolio almost always wins, not because 7% is better than 12% in theory, but because the investor who holds through 7% returns without flinching will always outperform the investor targeting 12% returns who panic sells at the bottom of every crash and re-enters after the recovery. The math of staying in the market, even at a modest rate of return, destroys the math of chasing high returns with low behavioral tolerance for pain. Your portfolio does not care how ambitious your target return is. It only cares about what you actually do when things get hard. Once you see this, once you really understand the engine swap and the emotional circuit breaker, and the purpose of having dry powder and the power of tax structure, you cannot unsee it. And from that point forward, you stop making the decision that keeps costing ordinary investors everything they've built. So let me walk you through exactly where to put your energy. Depending on where you are right now, if your portfolio is under $250,000, the answer is almost aggressively simple. Stop overthinking the investments themselves. The fund you pick matters far less than how much you put in each month. Your highest leverage action is to increase your savings rate, even by $50 a month, and to automate every single transfer so that the decision of whether to invest this month is never left to your willpower on a bad day. The machine wants to be fed. Your only job right now is to feed it consistently and resist every temptation to complicate things before the portfolio has the mass to justify complexity. Every hour you spend researching obscure investment strategies at $40,000 of net worth is an hour you could have spent earning or saving another $100. Feed the machine. If you are approaching $250,000, anywhere in the range of $200,000 to $300,000, the most valuable thing you can do this month is audit your tax architecture. Not what you own, but where you own it. Look at your accounts. Identify which room holds which type of investment. Figure out if your highest growth holdings are in the right room. This is not exciting. It will not make you feel like a sophisticated investor who is beating the market. But the investor who quietly reorganizes their asset location at $200,000 and then leaves it alone for 20 years will, with near certainty, retire with more money than the investor who spent those same years trying to time the market and pick winners. Boring wins every time. And if you are already over $250,000, there is one specific action I want you to take this weekend, not next month, not when you get to it. Write your emotional circuit breaker. Take 20 minutes. Open a blank document or a notepad. Write down exactly what you will do when the market drops 20%. Write down what you will do when it drops 30%. Write the rules while your rational brain is running the show. And then store that document somewhere you can actually find it when you are afraid, because that is the only moment it will matter. The 20 minutes you spend writing that document today could save you tens of thousands of dollars, potentially more. The next time markets go through a real correction, $250,000 does not make you rich. That is not what this number means. It is not a finish line, and it is not a guarantee of anything. What it is, specifically, is the moment your money graduates from a glorified savings account into a wealth-building machine. Before that threshold, you are the engine. After it, the portfolio is. Before it, your savings rate is the most powerful lever. After it, your positioning, your psychology, and your tax structure are. Before it, growth is the primary goal. After it, the ability to hold through the storm becomes just as important as the return you are chasing. Everything before $250,000 is preparation. Everything after it is acceleration. But acceleration only happens for the person who understands that the rules have changed and responds accordingly. The person who treats a $300,000 portfolio the same way they treated a $30,000 portfolio will not accelerate. They will plateau. Or worse, they will panic at the first large number crash and undo years of progress in a single afternoon. You now know the engine swap is real. You now know the emotional circuit breaker is not optional. You now know that dry powder is not just a hedge. It is a weapon. You now know that where your money sits matters as much as what it sits in. And you now know that the boring portfolio held with conviction beats the exciting one every time. The game does not have to be complicated, but it does have to be played at the right level for where you actually are. And that, knowing which level you are on and what that level actually requires of you, that is the thing most investors spend their entire lives never figuring out. I will see you in the next one. And if anything in this video felt uncomfortably familiar, that feeling is not a flaw. That feeling is the first sign that you are paying attention.